we've seen a few successive years of good equity returns for investors. But can it continue, especially given the exciting start we've seen to 2026? Joining me today to ask whether it's possible to construct portfolios that can fare well in a variety of circumstances is Chief Investment Officer John Gilchrist. So John, to kick us off, can you provide a recap of PSG Asset Management's philosophy and 3M investment process and highlight how it enables us to construct resilient portfolios for our clients?
Certainly, Adrian. Thanks very much for the opportunity to talk to you today. I think it's important to always go back to the basics, the philosophy and the process. And in our case, our philosophy is around finding mispriced quality. We look in areas that the market has neglected, that are out of favor, for opportunities in that area. And those opportunities, because they're out of favor, are often relatively cheap. But simply being cheap and out of favor is not sufficient. We try to find within those type of opportunities an inherent quality that the rest of the market has missed. And examples of that could be something that's short-term in nature that is being resolved. It could be a prevailing narrative that actually doesn't stand up to scrutiny and research. It could be poor management that are subsequently now moving out and being changed, or a supply-demand mismatch that has not been fully understood by the market. So there are a number of areas where we can find that inherent quality. Once we found those sort of opportunities from a philosophical perspective, then we move into our 3M investment research process. And many investors would be familiar with the 3M process. We've used it for many, many years consistently. And it's really about finding quality in the form of an assessment in an in-depth manner on the moat and on the management, and then marrying that with a really, really good price being our margin of safety. So moat management, margin of safety, the 3M process that really guides us through those initial opportunities through to what we want to include within our portfolios. Now, it's really important that we are a bottom-up, research-driven house. We pride ourselves on our independent research, and we really make sure that the opportunities are in our portfolios on their own merits. And as a result, we are not hamstrung by having to be within certain parameters around indices, nor are we hamstrung in terms of using a strategic asset allocation where we upweight and downweight small amounts. We are cognizant of index levels and we're cognizant of a normalized strategic asset allocation, but ultimately the bottom-up research that we do is our primary determinant of what goes into our portfolios. And as a result, those portfolios tend to be differentiated from many other competitors. They performed incredibly well across all our mandates over the medium term and the longer term. But they also tend to be a bit differentiated. And so when you look at a multi-managed solution, we think our philosophy and our process is perfectly designed to be, for us to be a significant value add within a multi-managed solution.
So John, many investors would be a bit skeptical that such a seemingly simple investment process could deliver good results in a variety of circumstances. So can you maybe provide us with some practical examples to highlight how this has worked, especially more recently?
I think that's an excellent question. And often they say, simplicity is incredibly difficult to achieve. It's the ultimate sophistication, I guess. But examples of our process in action are incredibly valuable. And so there are two that I'll highlight, even though there are lots that we do have available, and particularly over the last year or so, these sort of opportunities have really come to the fore and shown the process really well. So the first one is a great example within the industrial area of our philosophy and process in action. And that example is Telkom. So if we go back to when we first started looking at the share, there was very little sort of actual quality visible from the outside. Many market participants would have seen this as a quasi-government type of business. Management hadn't covered themselves in glory. The history had been pretty poor there, including a very value-destructive acquisition of the Business Connection Group. And as a result, it really wasn't seen as a great company from that perspective. On top of that, there'd been massive capex spend. Free cash flow was really low, and there was clear evidence of a declining legacy copper position. So a lot of market participants would have looked at this and said, we pass. we did our in-depth research, and what we discovered was a very, very strong fiber business in the form of OpenServe, and an excellent mobile business, Telkom Mobile, that was pursuing a strategy that was taking market share from the big incumbents, from the MTNs and the Vodacoms. And so we saw a business with a portion of the business in decline and a hidden areas, the OpenServe and the Telkom Mobile, that were growing and developing very, very well. It's also important to note that Telkom had invested roughly 3 times its market cap over the previous decade in these two businesses. And so that was sufficient to get us over the line to start investing, in which we did so between 25 Rand and 30 Rand. And ultimately what happened is that legacy copper business continued to decline, but eventually after about a year, the evidence started coming through that this was becoming smaller in the mix, and those growth engines were really coming through nicely. Margins were increasing, growth outlooks were increasing, and suddenly the market woke up that this was not the Telkom that they had been used to historically. And the share price rallied significantly. It's currently close to 61 Rand. So a great example of out of favor, unloved, cheaper opportunity, and the inherent quality that our research revealed, we were able to position and do very, very nicely for our clients. Another example is in precious metals. Now, we've spoken extensively around gold, so I want to maybe talk more about platinum. So platinum group metals, the narrative in particular around platinum itself was that EV demand was going to move through the roof. As a result, platinum demand was going to decline because of the auto catalyst usage within ICE vehicles. That need was going to decline, demand was going to decline, and as a result, the PGM prices were really in the bottom. We felt that assumption around EV take-up was probably overdone, but as often is the case on resource shares, we actually focused more on the supply side than the demand side. The demand side, incredibly difficult to predict. Supply side, especially when it comes to a resource like platinum and palladium and rhodium and the like, you can actually see very clearly what the supply outlook is going to be. You know what the decline rates are, you know how much capex is being invested, and you know how long it takes for that capex to result in increased supply. South Africa, you're looking at 70 to 80% of the world supply of platinum, so we know that area incredibly well. And ultimately, if you're in an environment where the supply that you're anticipating, which is very, very precise in terms of what you know is coming out over the next couple of years, if that is below a very conservative demand assumption, that's an incredible setup in terms of the price of the underlying commodity. Now, you don't know the timing, and so we're patient. We're willing to put on these positions. We're willing to have them go against us and reassess them and constantly sort of recheck that our assumptions and our research is correct. But we're confident that at some point that is going to come through, and it came through spectacularly in 2025. We had large exposures to the likes of Northern Platinum and Valterra Platinum, with the platinum price up 127% last year, and you get a geared type of exposure on that into the platinum names. We did very, very well for our clients.
So looking forward, where are you currently finding opportunities applying this process?
Yeah, so it's always a tricky one looking forward, because sometimes we're in process, sometimes we're starting to nibble, so we don't want to let the cat out of the bag. But certain areas where I can give some insights into what we're thinking about is, firstly, in terms of US healthcare. The US market clearly is stretched at a headline level, but there are still lots and lots of opportunities out there, as there are broadly globally. Even with headline indices stretched from a valuation perspective, we're still finding these areas that are totally neglected, that are out of favor. US healthcare, and in particular, so-called HMOs or MCOs, so managed care, has been a real darling for many, many years, a very, very well-run business sector, strong earnings growth, not quite blue chip, but certainly one that has really stood out over many, many years, and as a result has been highly rated. What we did see is over the last, certainly since 2022, mid-2022, earnings have declined, and in fact they've been decimated by both costs increasing as well as issues in terms of the revenue side of it, and there's been a regulatory overhang. Now, we see this as cyclical. We're seeing a lot of actions that these companies can take from a management perspective and also the overall supply demand that leads us to believe that these decline in earnings are cyclical, and we are already starting to see indications that it will rebound, but over not 1 year, but possibly 2 to 3 years. Now, the market does predict in advance, so we don't sit back and say we will jump in when we see that that's going to come through definitively, because it's too late. So we have positioned ourselves well in the likes of United Health, Humana, Centene, Elevance, and we believe that these companies are going to really deliver and outperform for us and our clients. Another area is in staples generally. What we have seen is that staples, because of their relatively lower growth and because of certain narratives around weight loss drugs, around the eating and drinking behavior of Gen X's and Gen Z's, around Gen Z's and what that it means for staple companies, both on the food side of it as well as potentially on the alcohol side. There's a narrative going around that these companies the growth is going to be massively affected. And we have seen some impacts on the earnings line, but the extrapolation of that narrative is pretty extreme. Also, what's probably quite important is despite all the noise and the geopolitical tensions that we're seeing, we are in a risk-on equity market environment. We've seen that from various surveys and various positioning, with cash levels at some of the lowest we've seen in the last 20 years. So we're in a risk-on environment. In that environment, dissenters type of shares like staples tend to be left behind. These are high-quality businesses, and we're getting a great opportunity to buy them at very, very low levels. And those sort of opportunities we don't miss out on. That's our bread and butter. And then locally, just very quickly, we've seen retailers come under significant pressure. Once again, we think the narrative is overdone. We think the negativity is overdone. And so we've opportunistically been taking selective positioning within that space into that weakness.
So, John, looking at the macro environment that we're in at the moment, it looks like it's going to be another very uncertain year, and potentially there's going to be a lot of volatility to contend with for investors in their portfolios. So if you have to share some wisdom and some insights, what are some of the key things that investors should be bearing in mind in the current environment?
Yeah, so we've said it many, many times, and we'll say it again. We think that too many investors are chasing the same sort of narratives and the same positioning. We're cautious about that. And, we think 2025 is a great example of how, even though the US did well and Mag 7 still did well, lots of other parts of the market and lots of other countries performed exceptionally well. We've been expecting that broadening out, and especially into emerging markets, for quite a long time. We are underweight significantly in terms of the US because we're not seeing the opportunities there. So going through 2026, what we can expect is, as you said, volatility, noise, geopolitical tensions. And so we think one needs to focus really on opportunities that are outside of the norm, that aren't at stretched valuations, that don't assume ongoing positive sentiment. We need to be broadened out, and we think our portfolios provide exactly that, a differentiated and diversified exposure, and areas that are already trading at low multiples, which we believe gives you quite a lot of protection in the event that you have some sort of risk off. If you're already trading at a low multiple, it tends to be lower beta, less downside in that sort of scenario. So we're seeing fantastic opportunities across a broad range of areas. And we think that sort of diversification at a portfolio level, and then what we bring in a multi-manager, is absolutely crucial for a year like 2026.
John, thank you so much for joining me today. I think we'll leave the conversation there. We've covered some good ground.
Thanks very much for the opportunity, Audrey.